Hi everyone, my name is Danabo. I am a tax consultant at Siam Legal. Today, I'll be sharing you the answers to some common questions asked by expats living in Thailand. The first question is, do I have to pay tax here? Well, according to the Revenue Code, Thailand imposes tax based on two fundamental rules, the source rule and the residence rule. Under the source rule, any person who in the previous year earned assessable income from work duties in Thailand, from business conducted in Thailand, or from business of employers residing in Thailand, or from property situated in Thailand shall pay tax. Under the residence rule, any residents of Thailand who in the previous tax year derived assessable income from work duties abroad, from business conducted abroad, or from a property situated abroad shall pay tax upon bringing the assessable income into Thailand. A person becomes a resident of Thailand for tax purposes if he or she stays in Thailand for a total of 180 days or more in a tax calendar year. Therefore, if you don't earn any income from Thai sources, you earn income from foreign sources during the years in which you are not a resident of Thailand, or you earn income from sources during the year in which you are a resident of Thailand, but you don't bring the income into Thailand, then you don't have to pay any tax here. And the second question that I often asked is, what action is counted as bringing income into Thailand? For example, if I withdraw cash from cash dispensers, use credit card or debit cards, or wire transfer to pay for goods or services in Thailand, will that action be viewed as bringing income into Thailand? Well, currently there's no statutory provision, Supreme Court's decisions, or the Revenue Department's rulings which defines the concept of bringing income into Thailand. So it remains unclear whether these actions will be regarded by the Revenue Department as bringing income into Thailand. However, according to the opinions of Professor Chayasit Drachutam, a former judge of Central Tax Court and adjunct tax professors of the faculties of Law Thammasat University, bringing income into Thailand does not necessarily involve importations of cash into the country. Transfers of foreign income to Thai bank accounts or any action resulting in foreign income being received within Thailand is also considered bringing income into Thailand. From his explanation, it seems like withdrawal of cash or from cash dispensers, or the use of debit cards or wire transfer to pay for goods or services in Thailand may be considered bringing income into Thailand, because this action ultimately leads to income being received in the country. However, for the use of credit cards, the answer depends on the natures of funds you use for paying back the loan. If it's from the foreign source of income, then it may be considered bringing income into Thailand. The third question that I often asked is, what constitutes assessable income? Well, according to the Revenue Code, assessable income is defined as not just only money, but also property or any other benefits received which may be computed into a monetary value. So salaries, pensions, fees, interest, dividends, proceeds from the sales of property, or rents from rentals of properties are a kind of assessable income which is subject to tax. The fourth question that I often ask is there a way to avoid double taxation because I've already paid tax in the countries of the payer of the income? Well, the answer is yes, and that is through reliefs under double taxation agreements. A double taxation agreement may be generally defined as an agreement between two countries which aimed to prevent double taxation. It eliminates double taxation by allocations of taxing rights between the contracting states. When exclusive tax rights given to one contracting state, the other contracting state must refrain from taxing the income. However, where taxing rights shared between the two contracting states, one contracting state, that is the state of residence, is required to provide reliefs for tax paid in the other contracting state, that is the state of source. Through this mechanism, double taxation is avoided. To give an example, US Social Security payments is assessable income from work duties abroad. So if you receive it during the year in which you are a resident of Thailand and you transfer it to your Thai bank account, generally you would have been taxed on that under the residence rule. However, According to the DTA between Thailand and the US, Social Security payments is taxable only in the countries of the payer. Because it is paid from the US, then it is taxable only in the US. In other words, it's not taxable in Thailand. The fifth question is, do I need to get a THIN or taxpayer identification number? According to an announcement of the Director General of the Revenue Department on tax identification numbers, taxpayers must obtain a tax identification number within 60 days from the date that he or she earned assessable income. What this means is that for Thai-sourced income, you need to obtain a THIN within 60 days from the date you earn that assessable income. Meanwhile, for foreign-sourced income, you need to obtain a THIN within 60 days from the date you become a resident of Thailand and have assessable income. For instance, if you are a resident of Thailand but you haven't remitted any foreign-source income into the country, or if you have already remitted foreign income into the country but you haven't become a Thai resident, then you don't need to obtain a THIN. These are the answers to some common questions I'm often asked by expats living in Thailand. If you have any specific questions regarding Thai's taxation, or would you like to schedule an appointment with our tax consultants to determine your tax liabilities and how to legally reduce them, please check the information in the description below. And don't forget to subscribe to stay tuned on the latest legal insights in Thailand. Thank you for watching and see you next time.